Equity Mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast that follows our journey of investing. Whether you're an absolute beginner or approaching Warren Buffett status, our aim is to help break down your barriers from beginning to dividend. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited. We are here for part 2 of our Value Investor 3-part series with Owen. We are still in our away kit.
We are still
We're still wearing our party shirts. I'm actually getting kind of jealous of yours. And I'm actually getting kind of curious to taste fairy bread again. If you're not watching on YouTube, that makes no sense.
Yeah, so today we're going to, well, firstly, welcome back, Owen Rask.
Thanks, guys. Appreciate it.
So Rask Australia and Equity Mates, if you're just joining us, have done a value investor program or a course that is available on the Equity Mates and Rask website, all about valuing a business. If you're interested in enrolling, details are in the show notes below, but there is a special discount code that you can use to get $100 off the course for a limited time. Details are in the show notes. The code is MATES, M-A-T-E-S, to get $100 off the course. As always, details are in the show notes, as I said, but you can use that $100 saving to go towards the investment or one of the stocks that you actually look at in the VIP program. Today, we are going to put the theory into practice with a valuation of Xero. Mm-hmm. We recognize that doing a valuation model involves a lot of spreadsheets, and we are doing a podcast. So we're going to keep it pretty high level. And there is going to be a video accompanying this on YouTube if you want to see what's going on Owen's screen.
And if you want to get even more in-depth, you can go to the Value Investor program where Owen walks you through valuations, including of Xero.
Yes. Xero's in there. There's about 5 companies in there, all very different, so you get a mix of everything.
So today we're just going to start with the origin story of Xero, have a chat about the business model, take a look at their management team, which is an important concept, chat about financials, and then hopefully get to some sort of evaluation at the end.
Yeah. Oh, we'll get a number out of you, Owen.
Yeah. I'll give you a number for sure.
So, Xero, it's an accounting software.
And for people who are unfamiliar, it's not Zero, it's XRO.
XRO.
Yeah.
The ticker is XRO.
Yep.
Yes.
On the ASX. Do you guys use Xero?
We do.
Yeah.
So your business uses this tool. Our business uses it. There's actually 5 businesses outside of the studio in our same office here. They all use Xero. And so what does Xero do? Well, it creates software that's used by accountants to manage small businesses. But as you guys know, you probably don't really need an accountant to do 99% of the things because the software takes care of it. And that's what's truly powerful about this software. You just access it through your browser. It costs starting at about $50 to $60 a month, depending where in the world you are. And you just connect it to your bank account and it reads the bank statements, sees where money is coming from, etc. And presto. So where did it actually start? So it didn't start this simple. It actually started in New Zealand, which is where its head office still is, which is fantastic. I think every great Australian technology business starts in New Zealand and it ends up in Australia on the ASX, which is wonderful. So thanks for that, our friends across the pond.
What are you saying about Zip and Afterpay?
Well, yeah, maybe there's a Kiwi connection.
Great Australian tech business.
No, but the Kiwi startup scene definitely punches above its weight in a huge way. So must be that fiber optic cable they got. But it's an incredible business because it started in around about 2007, and I think it was originally called Accounting 2.0. But basically, the idea was that, I guess it's just a play on the web, right? Because we were in 2007. I'm assuming the 3 of us are just old enough to remember that the internet had just transitioned from you can only read what's on the screen to you can actually put stuff in and get things out of a website. And so this is basically like the emergence of like cloud computing as we know it today, like sending a message across the internet and getting some sort of reply through a browser. And the businesses that had gone before this, like Salesforce, that was the pioneer of this idea called SaaS, which is where you can sell a software product through the internet on a subscription. And Xero, in particular, Rod Drury, saw this.
Let's not discount the true pioneers of that, the good Australian company that didn't come out of New Zealand, Atlassian.
Atlassian, yeah, absolutely. So, and they pioneered not just that, but they also pioneered how to grow an incredibly lean business profitably insane. So Atlassian unfortunately doesn't trade on the ASX, but it trades in the US under the ticker symbol TEAM, if you want to remember that one. But Xero is this idea that you could access accounting software from anywhere. And the key thing to understand is what happens behind the scene. When you traditionally use software, like say, remember Microsoft Office used to come on a disk?
Yeah.
And you'd have to buy a new one every year, and you'd have to put in like a code and it would install and blah, blah, blah.
Yeah.
Well, that's what accounting software was up until only like 2 or 3 years ago, really. So this was 2007, and they were like, well, we don't want to do that. We just want to deliver one version via the internet. And if you have a subscription, you get it. If you don't pay your subscription, you don't get it. And they did that. And that was revolutionary because it basically meant that you could access servers and internet from anywhere, and you don't need a disk. You don't need 10 different versions of MYOB. For those who don't know, MYOB was the big gorilla here in Australia.
Yeah.
What's interesting is the founder of MYOB was actually one of the earliest investors in Xero, and actually took a board seat and wanted to effectively buy the whole company.
Yeah.
But Rod Drewy, who's the founder of Xero, said, no. Like, I want this thing, and it's an incredible business, listed on the New Zealand Stock Exchange, then came across to Australia, consolidated the New Zealand into Australia. And Rod Drewy stepped back a few years ago, and a guy who has a pretty rich backstory named Steve Vamos, who from Microsoft and Apple came across and became CEO. And we can get to management in a second, but the basic genesis of the business over time has made a couple of small acquisitions, but mostly organic growth. It's been unprofitable basically the entire time. And the acquisitions that it has made has not changed the backbone necessarily of the software. What it's done is it's just added important features. So one of the things that I mentioned before was the ability to read a bank statement. They actually bought the company that was doing that for Xero to bolster that out, to make sure that it wasn't able to disappear overnight to a competitor or something like that. And then they've made a few other things, like they've bought Plan Day and a few other businesses that do like HR administration and those types of things. In terms of a business that is bold and has redefined what technology can do from Australia and New Zealand, and then in the UK, incredible. Xero's kind of like the poster child for that.
So that's the origin story, and you've mentioned subscriptions there a number of times. So what at its core, what is the business model for Xero? And you mentioned competitive advantages as well. So how is it building its competitive advantage?
Yeah, so it's a very, now that we look at it today, like everything's beautiful in hindsight and so obvious. You can actually see, if you look in the financial statements, that the business's revenue is just growing rapidly. Like this is the sales like from those subscriptions. And the reason it is doing that is because when you take a subscription, as you guys know with Xero, you get locked in basically because you don't want to give up the software. So it's super sticky. And you can only have a successful subscription business if the thing that you're selling is sticky. Because what happens is instead of spending like $1,000 on, that's an extreme example, but imagine you spent $1,000 on Microsoft Office today, right? Versus just paying $10 a month, right? You're foregoing a huge upfront cash flow in exchange for a very small fee ongoing. So it takes years for all of those subscribers to stack and layer on top and on top and top and top. And that's the basic business model, is get them in the door with a low price subscription that they'll pay again and again and again and again. And then all of a sudden you go from having 10,000 subscribers, 100,000, 1 million, 3 million. And that's when you really see that revenue just rocket straight up, like that inflection, that exponential growth. And so that's the basic model of Xero, is trying to get more and more subscribers into the ecosystem with discounting, with like sales tactics like expos with accountants. I think the best business models, one of the best business models, is when the person who pays the bill is not the person who's like facilitating the sale. So what I mean by that is an accountant is the one that sells the software. You don't go and necessarily get it off the shelf. So you get recommended it, but the accountant doesn't pay, you pay. And this is like, if you guys are familiar with Burson Auto Parts here in Australia, or Batcore, it's on the ASX, and you'll see Burson stores around. And Burson, what it is it's like automotive parts. But if you think, when you go to a mechanic, you don't care where it comes from, you just pay the bill. So for a business like Burson, when you go and you take your car down to the mechanic recommends, we need, a crankshaft. I don't even know parts, but let's be honest, you need brake pads and all that sort of stuff. They go to Burson and get it. So you're paying Burson without realizing. because the professionals recommended it. So you would never question it. It's the same model with Xero, but it's a software for accounting. And that's the model. And the reason people hate the business model, if I could just quickly touch on that, is the business is not profitable. So what I mean by that, if you look at the income statement, you go down and you see that line that says net profit after tax, it's a big negative in there. And at the end of the day, the reason that is negative is because they're investing so much for the growth to get that revenue.
So the switching costs are high. I couldn't imagine trying to switch to an MYOB or a QuickBooks or something like that now that we've got a couple of years worth of data in Xero, and that's what locks us in, and that's what makes us wear price hikes if they come, and that's what makes it easy for them to cross-sell, the next bit of software and the next bit of software after that. When Bryce has a full team under him that he's trying to schedule and stuff like that, it makes sense to just do it in Xero because we're already there.
Yep.
So that's the competitive advantage. That's the moat. Before we talk about competitors, let's just stay focused on Xero. You said it's not profitable, but it is growing. Give us a sense of the top line growth, the revenue growth.
Yeah, sure. In 2017, revenue was $295 million. By 2022, it was $1.1 billion. So it's expanding rapidly. And to your point about a business that can increase prices, if you think about Netflix, 100 million subscribers.
220 million.
Yeah, I was going to use round numbers. but
100 million. Call it 100 million.
So if you have 100 million subscribers, right, and you charge, say, again, round figures, you're charging, say, $15 or whatever. If you increase the price by $1 a month, it's $100 million every month. And then you times it by 12, you've got a business that just got free money. And so that's exactly what can happen with Xero. Over the last, say, 5 to 10 years, that has not been the game. The game has not been increasing prices. The game has been getting people in the door. And the way that's reflected in the financials is you see this thing called customer acquisition cost, or CAC for short, CAC. And you see that all the time. And they are very upfront about how much it costs to acquire someone. And it's a very transparent way to illustrate the business model. And what we will see as the business grows is we'll see that CAC probably increase because the harder customers, the ones that are really resistant to change, they are harder to convince and they cost more money to convince. So what we'll see is that probably go up. But what we'll probably see, to your point, Ran, is the value from each subscriber go up because they'll start increasing prices. And that's where you get this really interesting dynamic of they won't spend as much on acquiring and they're getting more from the existing subscribers. So the profitability just explodes. And that's what we call an inflection point. And that, for the most part, is Xero's jam. That's where it is now. It's still in this process of over 3 million subscribers, probably, a few more million that could come onto the platform pretty quickly over the next 5 years. But then after that, or even until then, it's just, how much can we increase the prices? And, even just most recently, the most recent results from Xero illustrated how powerful it is. Increasing prices just modestly, not just even through the subscription, but they also charge developers to build in their app store, just like Apple does, which we'll profile in a minute. And that's another way where it can just slowly jack up prices. Yeah.
All right, Owen, let's pause there and take a quick break to hear from our sponsors.
So we're here to understand the valuation of Xero, and we've spoken about a couple of key metrics here: subscriber numbers, prices. Ren's spoken about revenue growth. If you can now, I guess, clearly sort of take us through the process that you would go through to try and get to a valuation for Xero, knowing that it's not profitable.
Yep. So
some of the valuation methods aren't going to work. How do you, and what are the assumptions that you're looking at to create a valuation?
Yeah, sure. So this is the simplest way to model any type of subscription business is the number of subscribers multiplied by how much they pay you gives you revenue, right? Because it's like customer numbers multiplied by how much did they pay gives you the sales, right? It's pretty straightforward. So then all we need to do is we need to have a sense of how fast subscribers can grow, like how big can it get in each market, which they tell us they have an estimate of 4 million potential customers in Canada, for example. And these are just small businesses. And then you go, okay, well, how much can they charge? At the moment, you'll see in Australia, it's about $50 to $60, but it scales depending on the number of employees and if you get add-ons and blah, 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 blah. But if you think about that, what you can see is different pricing levels over time as well. So you would expect that as businesses grow, they start to pay more. And then even though it's not profitable, we can start to just from those two numbers, we can start to get a sense of the value because we know how much revenue it's got, how much it's making in sales. And so we could say, price to sales ratio, if you want to go down that path, because it's still growing. You could say, I don't know the exact number off the top of my head, but say Xero is like 10 times sales, as in the company's worth, according to the market price, 10 times the annual sales of the business. But you could say, well, I think it's going to grow sales, further, and I think 10 times is a reasonable price to pay. Then you know that it's probably going to go up in time. What I do is I take the number of subscribers multiplied by the price, and then I just feed that straight into my own income statement. So just like you would see in their annual report, I just put this extra step on top of it, if you like, where I'm just trying to predict what might happen in the future. So you've got total subscribers, and I do have it on the video version, but total subscribers. And then I look at, well, how big can they grow in those marketplaces like Canada, UK, Australia. And then I basically just get to that revenue line and I make some assumptions about the profit margins. Then from there, you just do a profit margin and you get down to cash flow.
So we're not going to talk through the details of the spreadsheet because that probably doesn't translate over audio, but let's just ask some questions to unpack sort of how you think this business goes into the future, because as we spoke about on the last episode, where the rubber hits the road, where the best valuers are separated from the average valuers, isn't in their ability to build a spreadsheet. It's in their ability to accurately assess a business's prospects. So, first question, when does Xero become profitable?
I'd say in the next 2 years.
Okay.
Yeah. So we're recording this late 2022, but it airs in 2023. I would say before 2025, it will be profitable.
Okay.
And you can actually, this is interesting, man. So I initially bought this a long time ago, these shares in this company. And my assumption at the time was this: if Xero wanted to, it could cut its marketing budget in half and be instantly profitable. And that was something that you don't need necessarily to model. You can just be like, they're spending like 300 million in marketing.
Yeah, you can look at that in the current income statement.
Yeah, exactly. Yeah. And you can be like, do they need all that? No, but do you want them to do it? Yes, because then that means if that's getting growth for the future, more subscribers, you would want them to spend.
And so what's the assumptions in that next 2 years that lead to it becoming profitable?
The key metric, so remember how I said before, you got the number of subscribers multiplied by how much they pay. So I am baking in a bit of expansion in the average revenue per user. So the average subscriber, basically what they pay. And so for me, that's looking like I've got it up to around about $35. If you look at just a quick
user. Per user.
Yeah. So the thing is, they don't collect all of it.
We're paying like 70, I think.
Yeah. So they don't collect all of it. So what can happen is the accountants can take a clip as it goes through, and this is a blended rate.
Is our accountant taking a clip?
Hell no.
No, it's not. If it is, it's not much. It's not normally that much. So they're probably not doing you dirty. But if you think about it, like, do you guys use Xero to pay super as well?
Yeah.
Yeah. So we do that as well. You can also have like the HR plugins, and they're like little add-ons. It's like $1 or $2 per employee and that sort of stuff. And so more and more, like you guys said, you've kind of like put your flag in the ground. I'm with Xero, not MYOB, not Intuit, whatever. You're going to eventually probably use that stuff because it'll be easier. And so for me, there's just one really nerdy thing I want to make clear is when Xero publishes its number for what it earns per user, average revenue per user, that's based on the last month, right? So if you look at this financial statement at the end of the year and there's that number in there, that won't match up with your income statement because they're taking the last month and saying our average revenue per user is this. But that doesn't show you what happened 9 months ago, for example.
All right, let's rip through a few of the key assumptions because I think that's the point that we want to get to. It's that the process of forecasting the future is a process of building assumptions, and the best modelers are right about more of their assumptions than they're wrong. So what's its revenue looking like in 2025?
In 2025, you're looking at about, and I'll just quickly jump to my spreadsheet, you're looking at about 1.7, 1.8 billion.
Okay, so 1.2 today, did you say? Yeah. So not unreasonable assumptions, you would say there. How far out do you model this?
I would go till Well, in the current model, I've got 2032.
Oh, wow.
Yeah, so this
Okay.
is a 10-year model. And do you want me to just tell you why real quick?
Yeah.
Please.
Yeah, so when you model a hyper-growth company, you cannot use a 3 to 5 year model, because what happens is when you get to the end of the 5 year, there's like a cliff and it just goes into like infinity. So you have to model it through the hyper-growth, because if you don't, you're going to miss out on the ability to have that insight over the 5 to 10 year window. And that's where you'll see a lot of this price inflection.
So what does 32 look like?
Well, 32, it's pushing $3 billion. Now, this is
$3 billion in revenue.
Yeah, this is my base case. I want to be clear about this. This is not like a super outlandish thing, I don't think. I've actually modeled the company to be approximately the share price today. Why did I do that? Well, it's not me trying to guess. It's me trying to say, what does the market think?
Yeah.
Yeah.
So to be clear there, you've built your assumption and that gets to your number of what the share price should be based on your 10-year model. And we'll ask you what that share price should be, but we'll put a bit in that. And then you've also done a separate model, which is not building on your assumptions, but taking the share price as it is and then putting what the market is assuming to get to that share price.
Yeah. And that could still be wrong. Like the
market is often wrong.
Yeah, it can be often wrong, right?
Now, hold on. Let's. So 2032, you're at $3 billion in revenue. What's your average revenue per user?
I've still got it around, it's actually at $36. So it's not that much higher. Now, this is what I'm saying. Like, if you think about that, there's a lot of scope.
Yeah. So you said it's got about 3 million users today. How many users does it have in 2032?
It will have approximately 7 mil.
Okay. So it's a bit more than doubled in size in the next 10 years.
Yeah.
And then finally, how profitable is it in 2032?
It's not.
So let me just scoot down here. So we're looking closer to $1 billion in profit.
Okay, so it's got like a third
good
profit
margins.
margin.
Yeah. So, and that's pretty aggressive, right, in terms of the profitability. But what I've done is I've basically taken, like I said, that marketing, and I actually think marketing will fall. And that's probably the key risk in the modeling, is I actually think marketing will fall. Now that if you take that in light of competition, maybe that doesn't happen. So this is again the art form with the science, but that's where you get the inflection point.
So just from taking the theory of a discounted cash flow and applying it to what you've got today, you've got profitable in 2025, and then you've got it's growing its profit from, I assume, pretty minuscule in 2025 to $1 billion in 2032. And so the task for you as the valuer is to say its profits stream in those 7 years might total a couple of $1 billion all up if you add those 7 years together. Yep. But I want to know what I'm paying for that future profit today. And so that's why you do a discounted cash flow, because the value of $1 today is worth more than a value of the dollar tomorrow. Mm-hmm. And the value of $1 in 2025 is worth more than the value of $1 in 2032. And the discounted cash flow is just the method to actually calculate what the value of each of those dollars are and what you should be willing to pay for them today relative to the rate of return that you want to get.
Yeah. And this is, you actually introduce a real key thing that happens in most models where they go wrong, which is this idea of like the future value is how do we get that back to today, right? And this is what we call the discount rate. So the discount rate, there's some fancy maths around it. It's really kind of pointless though, because you can think of the discount rate as my expected return, right? So what return do I require from an investment in order to make the investment? So if I think Xero is really risky, well, I want to have a higher discount rate because I'm taking more risk. So give me more of an expected return. And so for this model, in this video, I've actually kept it really simple. It's just 10%. So I expect 10%. Now, there are many different schools of thought on this, which we probably don't have time to go into. But for me, I think Xero is one of the highest quality businesses in Australia. So I just think the quality of the business, its products, its services is really up there. And so what, in theory, if you think something's like a really good business, wouldn't that mean that it's lower risk, right? But if you punch that into a model, your upside is huge. So I tend to be conservative in that approach, and just say, what do I need to basically justify an investment at today's prices? And then all of that other stuff is like, that's just make it rain. Like that's great. That's upside that I'm basically not assuming. But there are plenty of risks and there are plenty of ways that this can go wrong.
So before we close out and get to the price, a lot of the assumptions that you've put in around user growth of sort of price per user, revenue per user,
cost base,
marketing, they're all assumptions that you've sort of come up with. But what's the flip side? Like, what could go wrong here, and what are the risks that you consider with those key assumptions?
Yeah, these things can change really quickly. And the big one is like I'm making assumptions that are probably not what will actually happen. And so what I mean by that is, you know how I said like I expect marketing to fall? That's my belief that it should. It should, because it will get more profitable if it does that. But the management team at the time could be like, no, we're going to try this other crazy idea. And so management is always a massive uncertainty when you're modeling so far out. And in the last year, Xero has got substantially, I would say, riskier when you look forward, because we've seen some changes. I said Steve Vamos announced he's stepping down in late 2022. He'll be stepping down in 2023. He's being replaced by a CEO that has a lot of experience in the US. Now, they've also got a chair who oversees the CEO role and the executive team and the board of directors. And the chair's David Thode at the time of recording. He has experience with Telstra, you may remember, and also Tyro Payments. And what I do is I study all of those people and I go back and look at how they've performed in the past. And my I guess my just broad strokes, my view is that they tend to be quite aggressive in spending. That would be my, like, from just looking roughly at their track record. And so if you think about that, that's not necessarily the best way to make a profitable business. It might grow at the revenue line, but does it grow at the cash flow? Maybe not. So that's a big risk. And the other thing, which we haven't really touched on, is just competition. So much competition coming, and things can change rapidly in technology, particularly in financial technology. And then finally, in the UK and Canada, the assumption is rapid growth. Because those governments are making tax digital. So that means that they're forcing companies to report their taxes digitally, but that could be kicked further down the road if things get too hard.
Yeah, now I want to hit on competition because I think that's probably the best illustration of where the assumptions in your model can really change based on what plays out in reality. So the assumption in your model was in 2032, there will be 7 million users.
Yep.
Unless Australia has massive population growth or Australia and New Zealand businesses just boom and we pump out like 4 more Atlassians, they're going to need to crack overseas.
Yep.
And they're looking at America. They've got an American CEO, but it's not like there aren't options in America. Intuit have QuickBooks, there's FreshBooks, there's a number of other strong competitors that have very similar business models. So how do you... I guess first part of the question is how did you get to the 7? Yeah. Second part of the question is how do you constantly stress test that assumption as more and more information is coming out?
Well, it's actually it's a great point, Ren. So when we first created this model quite a few years ago, the best source for us was the national government like databases. So in Australia, we know the ABS, Australian Bureau of Statistics, has business numbers. In the US, there's like I think it's called the Bureau for Business or something like this, Federal Bureau for Business, and you can get the data from them. They publish it every month. Same in the UK, so you can get that, and you can also see what competitors are saying just to sense check it. So Xero wouldn't serve Atlassian very well at all. The Atlassian business would probably break if they tried to use Xero, because it's typically for businesses up to 1 to 200 employees. You don't really, then you go to something more.
All right, forget 4 more Atlassians, 400 more equity mates. But
yeah. So that's probably more like it. And so most of the growth from the business will come outside New Zealand. Definitely, that's already maturing. They dominate that market end to end. Here in Australia, they basically dominate the market end to end. Now, the latest data shows that there's around 900,000 subscribers in the UK. And now in North America, there's this bucket of North America. People think that that's the US because that's where they were trying, and they still are, as far as I know. But the big one there is Canada, where the tax system is much more like Australia. Whereas in the US, you have like each state has different HR and tax rules, which is super complicated. In my opinion, that is completely won and dominated by Intuit, which is the owner of QuickBooks. But outside of that, Canada is a frontier where they can potentially win with the right management. And you've got to think, like even in North America, they have 354,000 subscribers. So this would be like Xero only a few years ago in Australia. Right, so this is not a small business in the US. It's more competitive for sure, but it's another one. And then you look at smaller geographies, maybe like Singapore or South Africa. That's what they bucket as rest of world. And I don't really think about that in the modelling. Like it's just like, it's basically, whatever comes. But UK, definitely, this is like, I believe that it will be Xero, Intuit, and then third spot way down is Sage. In Canada, it'll probably be Intuit, Xero, and then the others. That's probably the mix.
Love it. Well, Owen, to close, I guess the big question is,
what's the number?
What's the valuation? What are you looking at in today's numbers?
Well, at the time of recording, I do a range, so I never don't want to be specific because people then take it and they're like, well, it's $2 undervalued, and they just make a lot of decisions around that. So my valuation is between $70 and $85. That's down from where it was a few months ago because of the change at the management level and some of the expenses growth. So that could change again, but between $70 and $85. Be careful if you're modelling it. That's my Australian dollar number.
Yeah,
it reports in New Zealand dollars.
Yeah, and for context, time of recording, we're at basically the low end of that range.
Yep. Yeah. So it's probably in the money, but it's a high quality business.
Not advice. Do your own research. Do your own modelling.
Yes. Yeah. Do your own educating as well. The Value Investor Program with all of the information, the steps, the checklists, the theory behind everything that Owen has spoken about today is in the Value Investor Program. It's available on equitymates.com under our resources section. It's also available on the Rask website. It's value for money, that is for sure. And if you are interested in building your own models and understanding the ins and outs of valuation, getting under the hood of companies, then certainly recommend. If you'd like $100 off the course for a limited time, use the code MATES, MATES, and you will save. Those details, if you're on the run and don't have a pen handy, are all in the show notes below with a link to the course as well. So that's MATES for $100 off the VIP course, limited time only. You will not regret it. Next episode, we are going to be unpacking the largest company in the world, and that is Apple. Ren will pick it up next week.
Largest publicly listed company
Largest publicly listed company in the world. Apple.
Sounds good.
We'll pick it up next week.
Thanks, guys.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.